Hey traders, Chris Bus here with Traders Profit Compass. It is Tuesday, September 21st, 3:20 in the afternoon. What I wanted to do is a quick video as a follow-up to the orientation video I did a few days ago on trading micro futures. So in this video, what I want to do is just orient you to the Thinkorswim platform. And of course, if you're using Interactive Brokers or another broker service with its own platform, I think you'll find similar setups in that platform. Obviously, I can't go through ones that I don't use, but I'll take you through the Thinkorswim setup just to orient you on how to set up your platform and certain elements of it for getting started with micro futures. Okay, here up in this corner is the where you enter the symbol, and as you'll recall, I gave you a symbol list. Most of the micro futures starts with an M and then the symbol. There are some differences. This one is \M2K, so this is the micro futures for the small caps. The big boy contract is RTY. The micro contract is M2K. You see that there. What I want to call your attention to is this line here, which shows you the contract that you're trading. Now, in the for the indexes, there's basically 4 contracts a year, spaced 3 months apart, and this gives you the expiration date, December 21st, for this contract. Now, when you first load up your system, it will put you by default in the current contract that's trading. So right now we're trading the December 21st contract for the micro futures for the small caps. Now, where that comes into play, for instance, if you were, say you entered a position in November and they were still trading the December contract, if you were to stay in that contract, for weeks and weeks, at some point you're going to want to roll your position to the March contract, right? The next one out, whether that's late February or March, I'm not sure, but I think it's March. So you'd close out and then re-enter your position in the March contract. So what you don't want to do is just, let this run out till the end when there's low liquidity in that contract. When it runs out, you always want to stay ahead of that. And most of the time, you're not going to be in a particular trade for, a month, but it is possible. So just be aware of that and kind of research with your broker or at the CME how rolling those contracts works. Okay, so this is commonly referred to as the trade ladder. This is live right now, so you've got a column for bids, and you see the various bids stacked up, and then over in this column you've got the asks stacked up. So those are the active people that want to sell at a particular price, and they've entered their orders in the ladder and then waiting for them to execute. And you can see there's good liquidity in the at this current time while the market's open. There's good liquidity there. There will be times, for instance, when our market closes at in the afternoon, there's going to be a dead period when futures close, and I believe that's 5:15 to 6 p.m. It's closed, and then it reopens at 6 p.m. What you'll find is, as the time goes from east to west, right? Anybody that's involved in the stock market that lives in California is getting up early to trade the New York session, right? So once the market closes, what you'll find is this liquidity will go down, but it won't disappear. You'll see, more single orders here, like under 10, and the same thing. And then as time goes on, as you move from California towards Asia, there'll be 5-6 hours of dead time where the liquidity will drop off. So, but as low as the liquidity might get, if you have an order anywhere in the chain, it will get filled. You will not get skipped over. But what you'll find if you watch it, if you study it, like if you come home after work and, pull up your chair at 7 at night, you won't have a lot probably going on. So until Japan and Hong Kong open, and then China, then it picks right back up again, and then you start the cycle all over again, rolling through Asia, then into Europe, then into our pre-market at 4 in the morning. So anyways, that's kind of how it works. So let's jump up here to the top, and I'll go through some things. You'll see a buy market order, so and a sell market order. So if there's a place in the chart where you just want to execute an order, you would just hit the buy button if you want, and then that'll they'll send a market order to the tape, and it'll get filled immediately. Same thing with a sell market. If you want to go short, you would sell it. So, and then you'll see here, I don't know if you can see it, but there's a button that says flatten, and then there's a button that says reverse. So if you had a live order and you wanted to get out of it, you could simply you could do that one of two ways. You could just hit flatten, and if you were long a certain number of contracts, it would just sell them. And if you were short a number of contracts, it would buy it. So it would take you to zero, hence the word flatten. And then there's a reverse. So for instance, say you were short a number of contracts and you saw a price was coming into support where you'd expect a reversal. Instead of, buying your contracts back and then going long, right? So you were short coming into support. You'd want to buy those to get out of it because you're expecting a reversal, and then you'd have to buy that amount again to get long for the bounce. So a simple way to do that is hit the reverse button. So then what it does seamlessly is take you from short to long with one click. So that can be convenient if you've identified a spot and you want to reverse your position at that spot. That's the way you can accomplish that. So here is where you enter the quantity of the contracts that you want. And you see here that it has, commonly used quantities. You've got a single contract, 3, 5, 10, and 20. And remember, these contracts are 1/10 of the big boy contract. So if you hit 5, you'd be effectively trading half of the large contract. And if you hit 1, then you would be trading 1/10 of the contract. Now you can see here I've got that set up as at 4. You can put any quantity in there that you want. And what I want to show you, this little question mark tells you the margin requirement for 4 contracts. And you can see here it's $2,860. So you've got to have $2,860 available, free, available in your account to execute that order. And if you're below that, it'll just bonk you out and it won't go through. And you can see right above that quantity times the tick. And so a tick is each increment of the, on the trade ladder. And you can see where for this, for small caps, there's 10 ticks for every point. You can see here, 292 and then, 2192, and then you go up to 2193. There's 10 increments for each point of small caps. So what you can do is, if there's 10 ticks for every point and every tick value is $2 with 4 contracts, then for every point it's $20 to the good or the bad, right? So and that goes back to, of course, the leverage factor works either for you or against you. It's great when it's going your way at $20 a point, and then when it goes against you, it's not so fun. So, but if I were to change this to 3, let's just do that. I'll change that to 3, and then go back. The value per tick goes down 25% to $1.50 a tick, or $15 a point, and then my margin requirement drops down to $21.45. And then so you can play with what you want to put on, etc., based on how much capital you have available, how much capital you want to have at risk, etc. And going back to the original video, I very highly suggest that you start all this on paper. Open a paper account, whether it's with Thinkorswim or whatever broker you intend to use, and get super, super comfortable with executing orders, picking a size, quantity of contracts that you feel comfortable with, because when you're talking $15 or $20 a point, it can add up quickly, either for you or against you. So one other thing I want to point out on the Thinkorswim ladder is this little thing here called template, and the default is they just call it a single, which means you enter an order to buy 4 contracts. It's going to execute 4 contracts. But what you can do is build templates for what you want to do or find yourself doing on a regular basis. For instance, if you always want to set a 3-point stop, so you want to say, okay, my risk is $20 a point, and I'm willing to risk 3 points, or $60 if I'm wrong. You can set up a a template for that, and so that when you place your order, it automatically will enter a stop for you, so you won't have to manually do it, right? So that can be really convenient. You can see I've got a couple of set up here for the micro NASDAQ and micro large caps, different things. And you can also set up OCO, which is one cancels the other. So you can, if you wanted to set up I'll just say a more complicated trade ticket, you could do that where, if this happens, I want to buy, but if that happens, I want to sell. And then once either one of those trades executes, then it cancels the other one. So I wouldn't necessarily advise like getting into these complicated trade tickets when you first start out. Just get a feel for it, entering your single contracts and then setting a stop and then setting a target. So let me just kind of go through some things that have worked or seem to have worked better for me. Now, what I've got here is just the end of the day. Yesterday, we had, we were down most of the day, or all day really, right till the end. So these are 5-minute bars working its way down. And then we reached the bottom, and then we got the ramp into the close. And if you can see down here, 1600, that's, of course, 4 o'clock. So this was the final bar of the regular session. The futures keeps on trading. Not a lot happened. You can see here as time goes on, the bars get tinier because, a lot of people have stopped trading. And then when the futures reopen, then you see more activity. So I'll just give you an example. Say you caught this bottom and you got long, and now you got a nice gain on your hands, but you said, you know what, I'm just going to let this thing ride overnight. I think we're going higher, but I don't want to, just go to sleep with an open position. You never want to do that, because you wake up and the opposite thing that you think was going to happen will definitely happen. What you want to do is say, okay, let's just say you're up $300, and then you say, you know what, I'm willing to risk $100 of that to let it go overnight. What you can do is find yourself a spot on the chart. I've got a level here. I'm not sure if that is a meaningful level. I'm just trying to give you an example. You could set your stop just below a certain level that in your mind, or technically speaking, that price should not go below if price is going higher. So you set your stop and then you walk away with the confidence knowing that, in the overnight session, whether you're there or not, if price comes down to your stop, it'll get executed and you'll be out, and then price, can go down or do whatever it's going to do. You know how it always works though, right? Price comes down and clips your stop because you didn't have it in the right place, and then it reverses and goes higher. That's just trading. That's the way it goes. But let's move forward. So if you're gonna try an overnight session, always set your stop. And if you're if you get more sophisticated with it, you can also set a target where you say, you know what, I'm right here in the middle. I'm going to set a stop below, but I really don't. I think price is going to go up to resistance and then stop. Then you can put your sell order up there, so that if price grinds its way higher overnight and finally reaches resistance, then your order is triggered and you captured your profits, and then you'll be out. So you can do it that way as well if you want to set a upside target. And what I recommend that you do is just play around with some of that stuff and see what happens, and take some notes on what you feel comfortable doing. And, you know, my experience is, you know, if I'm letting something go overnight and I've got a nice profit, what usually happens is, you know, I set my stop too close and then I get, you know, ticked out, stopped out, because I didn't want to give up a bunch of money, right? And then it reverses and goes higher. I mean, it doesn't always happen that way, but it seems to do that quite often. And I think the key is having a place on the chart technically that's your stop is the right way to do it, and not look at it like, well, you know, do I really want to give up half of my profit for a potential gain? You know, if the real technical level means it could come down and cut your profit in half, go from 300 to 150, are you all right doing that? And if you're not, just take your profit and then pick it up the next day, or whenever you're going to start trading again. So I think, so this is the pre-market today, and I'll tell you what I did that worked out well, and a kind of a strategy that's worked better for me. I have found that the most important thing in trading these futures is to get a really great entry point. And if you get a really great entry point, you can afford to let the trend be your friend if the trend does in fact develop. So when I get up early. So right here was 4 a.m. where I have my cursor, and you can see that price really could not take out that level, and it spent literally hours right at that level, could not go above. And since I kind of had a bearish bias from yesterday's session, and when I saw that price was having trouble at that predefined level that I had from yesterday, then I said, you know what? I'm going to try a short. I'm going to set my stop above. You know, I had a close stop. Here was the high. Here's where my level was. So I set, a fairly tight stop that if price all of a sudden broke out, I would be stopped out with a paper cut and obviously be wrong. And then at that point, I could have decided, well, you know what? I want to get long now because we just broke out. So anyways, so I got short, and what I found is the most, if there's a nerve-wracking moment, it's when you first enter a position and you can get like a stray bar come up and clip your stop, and then, of course, go the way that you thought it was going to go. But that's trading. So anyways, I got short, and then the trend started developing. And what's nice about getting a well-defined nice spot on the chart technically is that once I was in this trade, I didn't really have to do anything. The trade started going in my direction, and then worked its way down. Here was the 9:30 open, and then price fell away rather quickly, and then found a reversal point, and then I was out of the trade. So that is an example where it worked out well. And what I found is, as I've been doing this, is getting that really tight entry at an important spot on the chart allows you to stay in a developing trend longer. And then what I did was, as price started falling away, then I could move my stop from, above resistance. I could move it down to the first swing high. Then when price moved down here, I could move my stop accordingly down because I saw 3 candles that couldn't get back over this level. Set my stop just above, and it works its way down. And then what you can do also, I don't want to get into like a ton of trading, just wanted to show you the platform, but then you could set your stop candle by candle if you think you're getting near the end. And if you had identified your target area, then as price came down, you could have just exited your trade or done that reverse position that I talked about, where you went from being short to being long, anticipating a bounce at a key level. Now, this was a level I had on the chart, but these levels down here corresponded to the lows from yesterday. So I kind of thought that when I got this big kind of waterfall move that it was going to come on down, but that turned out to be not the case. But one thing you need to guard against is, so now you have your big win. Maybe you got this move, maybe you didn't. But when you get in stuff like this, hours of going nowhere, it can just chop you to pieces, right? You set a stop, you get taken out, and then, oh my God, it just reversed and went the way I thought it was going to go. You get back in, and then it reverses. And so pretty soon, your nice, easy trade from in the morning, it just paper cuts add up when you're, if you're setting a $50 or $60 stop, then 4 trades later, you just lost $200 or $250 or whatever it is. So that's why I say the best trades I've ever done in the futures are trades where I get a great entry and the trade starts to work right away and a trend forms, and then I can just let it work. It doesn't always work that way, but I just want to caution you, and you'll discover this if you practice on your paper trading account. It looks really easy to say, oh yeah, I'm going to buy at support, and then I'm going to sell here, and then I'm going to short that level back here again. If you're a sharpshooter like that, you're going to make $1 million. You really will. If you can catch every 5-minute swing high and swing low, you're Jesus Christ of trading. You'll find it's more difficult, especially on a 5-minute chart that's moving. It's tough. It is tough, and you've got to have your discipline set up to where you know the trades that you want to take, and you have the discipline not to take, the junk because you're bored or whatever, and wait for those optimum entries where it's clear as a bell and you can let the thing run. Now, and if you catch it right, you can let a trade run for days. And I've done that before. And there's no better feeling, because if you take let's just say the scenario, you take a long at key support, right? I mean, it's either going higher or you're wrong. And so if you catch something at key support and you get that first day's move higher, then you're in the money from the get-go, and you're going to make price take you out. So as price grinds higher day after day, you can just ratchet up your stops to the, each successive swing low, and just stair step your way higher. Or, the reverse is also true. Stair step your way lower, and forget about that idea of, I'm going to go long here, and then I'm going to reverse and go short, and I'm going to catch that low and go long. And like all day long, you're going to catch all these swing highs and swing lows. If you're that good, by all means do it, but easier said than done. And I've found that it's a lot, the best trades are when you can get that key optimum entry point and just let it grind away. And if you're lucky, you can get like a 2 or 3 day trend move where you can just stay in that trade and just watch it grind away, and then just gradually raise your stop up to where, if price reverses and takes you out, then price took you out. That's what you want to have happen. You want price to take yourself out, not you trying to guess, oh, well, it's run too far, I'm going to close it out. You may find that you shortchanged yourself because stocks can go higher than you think. Now, one last thing before we wrap this up. All the margin requirements are not the same. So 3 contracts of micro IWM at 2150 margin requirement, you put that same number of contracts in for the micro NASDAQ, and it's going to be $5,000, not $2,100. Why? Well, because it moves faster, it has higher volatility. And I think as you move to things like oil and whatever else you might want to trade, you'll find that the contract size is different. Some have very large leverage factors, and you may find that, even at 1/10 of a big boy contract, you might find it uncomfortable. So be sure you're comfortable paper trading and you know what those margin requirements are, so you know exactly what you're dealing with, and then you won't get hurt. So I think that about covers it. Let's just go over this as well. I stack my indicators below the chart. You can, do it however you like, however what your trading style, what indicators you might want to use. I have RSI, I have MACD, and I have stochastics, which I don't heavily use, but I do use the MACD and the RSI quite a bit in conjunction with my bread and butter, which is finding the right levels where you think price should react. So that's my style. You should follow your own style and then adapt that style to the micro futures. But I think you'll find them very powerful. And, I just remembered one other thing, that when you have a futures contract, unlike an options contract, there is no decay. So, for instance, you buy a weekly option on SPY, you know that, if it's Tuesday, you're going to be losing value every day as it marches towards expiration on Friday. You don't have that in futures. I mean, the leverage is the leverage. You're either in or out, and the trade is either working or it isn't. So you don't, if you get into a day or two where price is range bound, but in general the trend is up, you don't have to panic and say, oh my God, my option's running, decay is eating me alive. I'm going to have to do something. In futures, as long as your stop isn't hit, you can stay there for a week and nothing will happen. Your position won't have any time decay with it. So that can be very powerful in and of itself. And you can stay in trades longer and then move your stop, accordingly as price moves in your direction. And you don't have to worry about a day where nothing is really happening. You can stay in that trade without concern. So let's wrap it up there. I hope it helped. And we may delve further into it with another follow-up video. But I think that about covers it for now. I encourage you to, get on your platform, open that paper trade account, and play with it and see if it's something that you might like. It's been a nice addition to my trading, and I encourage you to at least investigate it. You may find that it's the best thing since sliced bread once you get into it. And if not, no harm done. You can go back to what you were doing before, or, run these things simultaneously with whatever else you got going on. So, hope you got something out of the video. This has been Chris Buss with Trader's Profit Compass. Talk to you next time.